A lot of people are talking about the 46% yield on RDTY. It sounds like the holy grail of passive income, a paycheck every single week while you sleep.
You will make your first million within 3 years. Okay? I'm going to repeat that. You will make $1 million within 3 years of your first day.
But I spent all night digging through the filings, and what I found is actually pretty terrifying. These 0-day to expiration funds like QDTY, SDTY, and RDTY aren't investing your money. They are actually liquidating you. In the last 30 days, some of these funds have actually been paying 100% return of capital. In plain English, they aren't giving you a dividend. They are just handing you back your own money, your own front porch, one brick at a time, and calling it income. Today, I'm going to show you the math that proves why your 40% plus yield might actually be a zero total return. Now, before I go further, I do want to put out a disclaimer that nothing in this video is meant as financial advice. These are simply my opinions, and as always, please consult with a financial professional. The YieldMax family of ETFs has gotten a lot of notoriety lately. They have ETFs that pay a significantly higher yield than quite a few covered call ETFs, and definitely the traditional ones like JEPI, JEPQ, even QYLD. According to them, the income that they generate compared to most dividends out there are pretty quick. And today I'm going to focus on arguably the three fastest ETFs within this family of YieldMax, and that is the 0 days to expiration universe. And in my opinion, this represents the most aggressive, high velocity strategy they have ever launched. A good way to think about it is the Fast and the Furious of the income world. Allow me to set the baseline for what 0 days to expiration really means, and it simply refers to options contracts that expire the same day. So when people talk about 0 days to expiration ETFs, they mean funds that use these option strategies inside the ETF. So a good way to think about it, instead of trading same-day options yourself, you're buying a fund that does it for you. Here's the appeal. The strategies can generate more income and respond much more quickly to market movement. And that's why funds like RDTY from YieldMax and others get attention. But here's the trade-off. Because the options expire the same day, outcomes can also change pretty fast. So that can mean higher income potential, but also more volatility, limited upside in some cases, and returns that may not look like a normal long-term index fund or even a traditional covered call ETF. So the easiest way to think about a 0 day to expiration is this. It's an ETF wrapper around very short-term options trading. It can be attractive for income-focused investors, but it's not the same thing as simply buying and holding the market.
I need you to release my options. If they're worth anything after today, I want my bonus, I'm out.
Let's also talk about ROC, or return of capital. A lot of investors see a big distribution and assume it's all income, but that's not always the case. If a payout is classified as return of capital, that means at least part of that cash is considered your own capital being returned to you, not pure income. Now, that doesn't automatically mean the fund is bad, but it does mean you need to look deeper. Because the big question is this fund truly generating yield? Or is it simply giving you some of your own money back in the form of a distribution? And I'm going to talk about this concept, ROC, return of capital, when I go into the actual funds themselves. Let's start with RDTY, which is YieldMax's way of giving you synthetic exposure to the Russell 2000. I do want to clarify that when you invest in RDTY, you're not actually owning any small cap stock directly. you're actually owning a fund, RDTY, which uses a synthetic covered call strategy tied to the Russell 2000 index. And at the same time, it sells 0 day to expiration out of the money call options to bring in that premium. So a good way to think about it is RDTY is trying to follow the price action of the Russell 2000 while layering on same-day options income strategy. Take a look at the distribution rate that is posted for RDTY, 46.8%. That sounds pretty hefty, pretty sexy, pretty exciting. But once we uncover and lift the hood, it actually becomes a little bit more scary. And let me show you why. So when I take a look at specifically the last 12 distributions for RDTY, of those 12, 6 times they gave back 100% return of capital. And what's even more revealing is that an additional 3 times were over 70%. So that means 9 times out of 12 in the last distributions, they gave you the majority of your capital back had you invested in it, or 100%. When I look at QDTY, the yield or distribution rather is 39%. But then when I look under the hood and take a look at the actual distributions, 6 out of 12 times it's a return of capital of 100%. And finally, SDTY. So their yield or distribution is over 33%. But again, they suffer from the same challenge in the return of capital over 70%. 7 out of the last 12 distributions unfortunately met that criteria for them. In summary, I'm going to give you 2 scenarios, 2 different investors. So who is the ideal investor for this type of ETF? If the investor already owns covered call ETFs, understands capped upside, and they just want a small tactical position for potentially higher income and more active strategy exposure, as long as they view it as a tool, then perhaps they'll be taking a look at this ETF. But if the investor mainly wants steady long-term compounding, minimal complexity, a fund they never have to think about beyond the headline yield, then a fund like this perhaps is not for them. This is for the covered call ETF investor who wants a turbocharged income tool. It's not for the investor who sees a high yield and assumes it works like a normal buy and hold fund. Thank you so much for watching. If you enjoyed this episode, please hit the like and subscribe button. It is my goal to provide you with a piece of content at least minimally once a week on covered call ETFs. Thanks again. Have a great rest of your week and live it prosperously. I'll see you on the next episode.